Welcome back, everyone. In the previous part of this unit, we developed a clear understanding of the meaning of demand, the law of demand, and the distinction between individual demand and market demand. We learned that demand is not merely a desire for a commodity, but an effective desire supported by both purchasing power and willingness to buy. In this second part of the unit, we will take our understanding one step further by studying two of the most important concepts in microeconomics: the law of demand in greater detail and the concept of elasticity of demand. Although the law of demand tells us that consumers generally buy more when prices fall and less when prices rise, it does not tell us how much demand changes. In real business situations, this question is extremely important. For example, suppose the price of a mobile phone increases by 10%. Will consumers reduce their purchases by 2%, 10%, or 30%? Similarly, if a supermarket offers a discount on cooking oil, how much will sales increase? Will consumers buy just a little more, or will demand rise significantly? The answers to these questions are provided by the concept of elasticity of demand. This concept helps businesses understand how responsive consumers are to changes in price, income, and the prices of related goods. It is one of the most widely used concepts in pricing decisions, taxation policies, international trade, marketing strategies, and business planning. During this lecture, we will study the detailed meaning of the law of demand, examine the determinants that influence demand, discuss important exceptions such as Veblen goods and Giffen goods, understand the various types of elasticity, learn different methods of measuring elasticity, and finally explore its practical applications in business and government policy. By the end of this lecture, you will not only understand why consumers change their buying behavior, but also learn how businesses use this knowledge to make better pricing and production decisions. Let us begin with a detailed understanding of the law of demand and its fundamental principle. Let us now understand the law of demand in greater detail. This is one of the most fundamental principles of microeconomics because it explains how consumers react when the price of a product changes. The law of demand states that there is an inverse relationship between the price of a commodity and the quantity demanded. In simple words, when the price of a commodity increases, the quantity demanded decreases, and when the price decreases, the quantity demanded increases, provided all other factors remain unchanged. If you observe the slide carefully, the first box titled "The Core Principle" summarizes this relationship. This inverse relationship is the reason why the demand curve slopes downward, a concept that we will understand more clearly in the next slide. But before accepting this law, we must understand an important condition mentioned on the slide: ceteris paribus. The phrase ceteris paribus is a Latin expression that means other things remaining the same. This condition is extremely important because the law of demand studies only the effect of price on demand. If other factors also change simultaneously, it becomes impossible to determine whether the change in demand occurred because of the price change or because of some other reason. For example, suppose the price of rice falls from 60 Indian rupees per kilogram to 50 Indian rupees per kilogram. Normally, according to the law of demand, consumers will purchase more rice because it has become cheaper. However, imagine that at the same time people's income also falls sharply due to unemployment. In such a situation, consumers may actually buy less rice despite the lower price. Here, the change in demand is influenced not only by price, but also by income. Therefore, the condition of ceteris paribus is violated. Similarly, if consumer tastes change or a new substitute enters the market, demand may change even when the price remains the same. To study the pure relationship between price and quantity demanded, economists assume that all these other factors remain constant. Now let us understand why demand usually falls when price rises. There are several economic reasons for this behavior. The first reason is the income effect. When the price of a product falls, consumers can purchase more of that product with the same amount of money. Their real purchasing power increases, encouraging them to buy more. The second reason is the substitution effect. When the price of one commodity falls relative to similar products, consumers switch from the relatively expensive product to the cheaper one. For example, if the price of tea decreases while the price of coffee remains unchanged, many consumers may purchase more tea instead of coffee. Another reason is the law of diminishing marginal utility. As consumers purchase more units of a commodity, the additional satisfaction received from each extra unit gradually decreases. Therefore, consumers are willing to buy additional units only if the price becomes lower. Let us take another practical example. Suppose a clothing store announces a 50% discount on winter jackets. Many customers who were earlier unwilling to buy at the original price may now decide to purchase one or even two jackets because the product has become more affordable. This illustrates the law of demand perfectly. However, remember that this law describes general consumer behavior. It applies to most goods under normal market conditions. In later slides, we will also study certain exceptions where demand may actually increase despite an increase in price. Therefore, the law of demand provides the basic foundation for understanding consumer behavior, market pricing, and business decision-making. It explains why firms frequently offer discounts, seasonal sales, and promotional pricing to increase demand. In the next slide, we will examine the demand curve and carefully interpret the graph shown in the presentation to understand why it slopes downward from left to right and how it visually represents the law of demand. In the previous slide, we studied the law of demand and learned that there is an inverse relationship between price and quantity demanded. Let us now understand how this relationship is represented graphically through the demand curve. If you carefully observe the graph shown on this slide, you will notice two axes. The vertical axis, or the y-axis, represents the price, P, of the commodity. The horizontal axis, or the x-axis, represents the quantity demanded, Q. These two variables form the basis of every demand curve in economics. Now look at the curve labeled D. You will notice that it slopes downward from left to right. This downward slope is the most important feature of the demand curve because it visually represents the law of demand. Let us understand exactly what this graph is telling us. Suppose we start from the upper part of the demand curve. At this point, the price is high, and therefore the quantity demanded is relatively low. Consumers purchase only a small quantity because the product is expensive. Now imagine that the price gradually falls. As the price decreases, we move downward along the demand curve, and at the same time we move towards the right, indicating that consumers are purchasing a larger quantity of the commodity. Therefore, every point on this curve represents a different combination of price and quantity demanded. The graph clearly demonstrates that. High price, low quantity demanded. Low price, high quantity demanded. This is why economists describe the demand curve as a negatively sloped curve. Now the important question is, why does the demand curve slope downward? There are several economic reasons behind this behavior. First reason, the law of diminishing marginal utility. As consumers continue consuming more units of a commodity, the satisfaction obtained from each additional unit gradually decreases. For example, if you are thirsty, the first glass of water gives you great satisfaction. The second glass is also satisfying, but slightly less. By the fourth or fifth glass, you may not want any more water. Since each additional unit gives less satisfaction, consumers are willing to buy more only if the price is lower. This contributes to the downward slope of the demand curve. Second reason, the income effect. When the price of a commodity falls, consumers can buy more with the same income. For example, if the price of notebooks falls from 100 Indian rupees to 80 Indian rupees, a student with 800 Indian rupees can now buy 10 notebooks instead of only 8. Although the student's income has not changed, the purchasing power has increased. This encourages consumers to purchase more. Third reason, the substitution effect. Suppose the price of tea decreases, while the price of coffee remains unchanged. Many consumers who previously purchased coffee may now switch to tea because it has become relatively cheaper. Thus, the demand for tea increases. The substitution effect therefore strengthens the downward movement along the demand curve. Fourth reason, new consumers enter the market. When prices are high, some consumers simply cannot afford the product. As prices fall, more consumers enter the market because the product becomes affordable. For example, when smartphones were first introduced, they were extremely expensive and only a limited number of people could purchase them. As prices declined over time, millions of additional consumers began buying smartphones. This also increases the quantity demanded. Now let us distinguish between movement along the demand curve and shifting of the demand curve, because students often confuse these two concepts. If only the price changes, we move along the same demand curve. However, if factors such as income, tastes, population, or the prices of related goods change, the entire demand curve shifts either to the right or to the left. We will study these factors in detail in the next slide. Finally, notice the sentence written below the graph. It says that the curve slopes downward because of the negative correlation between price, P, and quantity demanded, Q. A negative correlation simply means that the two variables move in opposite directions. When price increases, demand decreases. When price decreases, demand increases. This simple relationship forms the foundation of consumer demand theory and is one of the most frequently used concepts in economics, business management, and public policy. In the next slide, we will study the determinants of demand and understand how factors such as income, prices of related goods, and consumer taste can shift the entire demand curve even when the price of the commodity itself remains unchanged. So far, we have learned that the price of a commodity influences the quantity demanded. However, in real life, price is not the only factor that affects demand. Many other factors also influence consumers' purchasing decisions. These are known as the determinants of demand. A very important point to remember is that these determinants shift the entire demand curve, whereas a change in the commodity's own price causes only a movement along the demand curve. If you look at the slide, three major determinants have been highlighted. Income, prices of related goods, tastes and preferences. Let us discuss each of them in detail. 1. Income of consumers. The first determinant is consumer income. Income is one of the strongest factors influencing demand because purchasing power depends directly on how much people earn. Generally, when people's income increases, they are able to buy more goods and services. Therefore, the demand for normal goods increases. For example, suppose a person's monthly salary increases from 40,000 Indian rupees to 60,000 Indian rupees. With higher income, they may decide to purchase a better smartphone, dine at restaurants more frequently, or buy branded clothing. This is why the slide mentions that an increase in income raises the demand for normal goods. However, the slide also refers to inferior goods. Inferior goods are products whose demand decreases when consumer income rises. For instance, a person with a low income may frequently purchase public bus tickets or inexpensive food items. As their income increases, they may begin traveling by taxi or purchasing higher quality products instead. Therefore, the demand for inferior goods declines as income increases. Thus, income affects different types of goods in different ways. 2. Prices of related goods. The second determinant is the price of related goods. Related goods are of two types: substitute goods, complementary goods. The slide gives the example of tea and coffee, which are substitutes. Substitute goods satisfy similar needs. Suppose the price of coffee increases while the price of tea remains unchanged. Many consumers may switch from coffee to tea because tea has become relatively cheaper. As a result, the demand for tea increases, even though the price of tea itself has not changed. This is called the substitution effect. Now consider cars and petrol, which are complementary goods. Complementary goods are consumed together. If petrol prices increase sharply, owning and operating a car becomes more expensive. Some consumers may postpone purchasing a new car because they expect higher running costs. Consequently, the demand for cars decreases. Thus, changes in the prices of related goods can significantly influence demand. 3. Tastes and preferences. The third determinant is consumer tastes and preferences. Unlike income or prices, tastes are influenced by psychological and social factors. The slide mentions fashion, preferences, and advertising. Let us understand each of these. Fashion plays an important role in consumer behavior. A particular style of clothing, footwear, or mobile phone may suddenly become popular because celebrities or social media influencers promote it. Even if the price remains unchanged, demand increases because consumers prefer the fashionable product. Advertising has a similar effect. Companies spend billions of rupees every year on advertisements because they know that effective advertising changes consumer preferences. For example, a new soft drink may become popular after an aggressive advertising campaign, increasing demand even though its price remains the same. Consumer preferences may also change because of health awareness. Suppose people become more health conscious. Demand for organic foods, sugar-free products, and fitness equipment may increase, while demand for sugary drinks and junk food may decline. Again, notice that price has not changed, yet demand changes because consumer preferences have changed. Understanding demand curve shifts. Now let us connect all three determinants. Whenever income, related goods, or tastes change, the entire demand curve shifts. If these factors increase demand, the demand curve shifts to the right. If these factors reduce demand, the demand curve shifts to the left. This is different from a price change, where consumers simply move from one point to another on the same demand curve. This distinction is extremely important in economics and is frequently asked in examinations. Practical importance. Businesses continuously study these determinants before making production and marketing decisions. For example, automobile companies monitor changes in consumer income before launching premium vehicles. Beverage companies observe the prices of competing products before deciding their own prices. Fashion brands carefully analyze changing consumer tastes before introducing new collections. Governments also consider these determinants while designing taxation policies, subsidy programs, and welfare schemes. Therefore, understanding the determinants of demand helps businesses forecast future sales, improve marketing strategies, and make better production decisions. In the next slide, we will study the exceptions to the law of demand. We will examine two interesting cases, Veblen goods and Giffen goods, where consumers behave differently and demand may actually increase even when the price of a product rises. This will help us understand why the law of demand does not apply universally to every commodity. So far, we have learned that according to the law of demand, consumers buy more of a product when its price falls and less when its price rises. This principle is true for most goods that we purchase in our daily lives. However, economics also recognizes certain exceptions where consumer behavior does not follow this normal pattern. In these special situations, demand may actually increase when the price increases. These are called exceptions to the law of demand. The slide highlights two important exceptions: Veblen goods, Giffen goods. Let us understand each of these carefully. 1. Veblen goods. The first exception is Veblen goods, named after the famous economist Thorstein Veblen. These are luxury goods that people purchase not only for their usefulness, but also for their prestige, status, and social recognition. If you look at the slide, it mentions snob value and conspicuous consumption. Let us understand these terms. Snob value means that some consumers believe a product becomes more attractive simply because it is expensive. They associate a high price with superior quality, exclusivity, and social status. Conspicuous consumption means buying expensive products mainly to display wealth or social position rather than to satisfy basic needs. For example, consider luxury brands such as Rolex watches, Ferrari sports cars, Louis Vuitton handbags, or designer jewelry. Imagine that the price of a luxury watch increases from 8 Indian rupees lakh to 10 Indian rupees lakh. According to the normal law of demand, sales should decrease. But in reality, some wealthy consumers may become even more interested in purchasing it because the higher price makes the product appear more exclusive. Owning such an expensive product gives them prestige and distinguishes them from others. Therefore, in the case of Veblen goods, a higher price may actually increase demand. This is why luxury companies rarely offer heavy discounts. Instead, they often maintain or even increase prices to preserve the premium image of their brands. 2. Giffen goods. The second exception is Giffen goods, which are much more unusual. Unlike Veblen goods, Giffen goods are inferior goods consumed mainly by low-income households. The slide describes them as highly inferior staples. Examples include basic food items such as low-quality rice, coarse wheat, or inexpensive bread in certain economic conditions. Let us understand this with an example. Suppose a poor family spends most of its income on rice because it cannot afford costlier foods such as fruits, vegetables, or meat. Now imagine the price of rice increases. Normally, we expect demand to decrease. However, because the family now has less money left after purchasing rice, it can no longer afford expensive alternatives. Instead of buying less rice, the family may actually purchase more rice because it has to give up buying other nutritious foods. In this situation, rice becomes an even larger part of the household's diet. Thus, the quantity demanded increases even though the price has increased. This unusual behavior is known as the Giffen paradox. It occurs only under very specific conditions. The commodity must be an inferior good. It must form a major part of the consumer's budget. there should be very few affordable substitutes. The consumer must belong to a low-income group. Because all these conditions rarely occur together, genuine examples of Jiffen goods are very uncommon. Comparing Veblen and Jiffen goods. Although both are exceptions to the law of demand, the reasons behind them are completely different. Veblen goods are purchased by high-income consumers seeking prestige and social status. Examples include luxury watches, designer clothing, luxury cars, and premium jewelry. Jiffen goods, on the other hand, are purchased by low-income consumers because rising prices reduce their ability to buy better alternatives. Thus, Veblen goods violate the law of demand because of prestige and social status. Jiffen goods violate the law of demand because of economic necessity and poverty. Practical importance. Understanding these exceptions is important for both businesses and policymakers. Luxury brands often adopt premium pricing strategies because higher prices strengthen their brand image. Governments, however, pay close attention to the prices of essential commodities because rising prices can significantly affect low-income households. These exceptions remind us that consumer behavior is influenced not only by price, but also by income levels, social status, and economic conditions. Therefore, while the law of demand is one of the most important principles of economics, it is not universal, and economists must consider these special cases while analyzing markets. In the previous slides, we studied the law of demand, which tells us that when the price of a commodity changes, the quantity demanded generally changes in the opposite direction. However, the law of demand tells us only the direction of change. It does not tell us the extent or magnitude of the change. This brings us to a very important concept in economics known as elasticity of demand. Elasticity of demand measures how responsive consumers are to changes in factors affecting demand, particularly the price of a commodity. In simple words, it tells us how much the quantity demanded changes when price or other determinants change. Look at the definition on the slide. It states that elasticity measures the responsiveness of quantity demanded to a change in one of its determinants, most commonly its own price. The key word here is responsiveness. Let us understand this with a simple example. Suppose two different products experience the same 10% increase in price. The demand for luxury chocolates falls by 25%. The demand for table salt falls by only 1%. Although the price of both products increased by the same percentage, consumer responses are completely different. This tells us that consumers are highly responsive to the price of chocolates, but hardly responsive to the price of salt. This difference in consumer behavior is exactly what elasticity measures. Now look at the two terms highlighted on the slide. Elastic demand. The first term is elastic demand. A product is said to have elastic demand when consumers respond significantly to changes in price. In such cases, even a small increase in price causes a large reduction in demand. Similarly, a small reduction in price leads to a large increase in demand. Examples include luxury goods, branded clothing, restaurant meals, air travel, electronic gadgets. Why? Because consumers have many alternatives and can postpone their purchases if prices rise. For example, if the price of a luxury handbag increases by 15%, many consumers may simply decide not to buy it. Therefore, demand is elastic. Inelastic demand. The second term is inelastic demand. A commodity has inelastic demand when consumers respond very little to price changes. Even if prices increase considerably, people continue purchasing almost the same quantity. Examples include salt, medicines, electricity, petrol, cooking gas. These products are necessities. Suppose the price of electricity increases. Will households stop using electricity? Probably not. They may reduce consumption slightly, but they cannot stop using lights, fans, refrigerators, or essential appliances. Therefore, the demand for electricity is relatively inelastic. Why is elasticity important? The slide also mentions that elasticity helps us understand the exact impact of price changes on consumer behavior. This is extremely important for businesses. Imagine you own a mobile phone company. Before increasing the price of your product, you would like to know, will customers continue buying? Will sales fall sharply? Will total revenue increase or decrease? Elasticity provides answers to these questions. Similarly, governments use elasticity while imposing taxes. For example, Governments often impose higher taxes on products such as petrol, cigarettes, and alcohol because demand for these products is relatively inelastic. Consumers continue purchasing them even after prices increase, allowing the government to collect more tax revenue. Practical example. Let us compare two products. Suppose the price of movie tickets increases by 20%. Many people may decide to stay home and watch movies on streaming platforms instead. Demand decreases sharply. Therefore, movie tickets have relatively elastic demand. Now suppose the price of life-saving medicines increases by 20%. Patients suffering from serious illnesses cannot simply stop buying medicines. Demand changes very little. Hence, medicines generally have inelastic demand. Law of demand versus elasticity of demand. Before moving to the next slide, let us clearly distinguish between these two concepts. The law of demand tells us the direction of change. It says, price increases, demand decreases. Price decreases, demand increases. Elasticity of demand tells us the degree of change. It answers questions such as, by how much will demand decrease? How sensitive are consumers? Will a price increase or reduce total revenue? This is why economists often say, the law of demand provides the principle, while elasticity of demand provides the measurement. Both concepts complement each other and are essential for understanding consumer behavior. In the next slide, we will study the major types of demand elasticity. We will understand price elasticity, income elasticity, and cross-elasticity, and learn how each type helps businesses analyze different aspects of consumer demand and market behavior. In the previous slide, we learned that elasticity of demand measures the responsiveness of quantity demanded to changes in factors affecting demand. However, price is not the only factor that influences consumer behavior. Demand may also change because of changes in consumer income or the prices of related goods. Therefore, economists classify elasticity into different types. If you look at the table on this slide, you will notice three major types of demand elasticity. Price elasticity of demand, income elasticity of demand, cross-elasticity of demand. Let us understand each of these one by one. 1. Price elasticity of demand, PD. The first and most commonly used type is price elasticity of demand, often abbreviated as PD. As mentioned in the table, it measures the responsiveness of quantity demanded to changes in the price of the same commodity. In simple words, it answers the question, if the price of a product changes, how much will consumers change the quantity they purchase? For example, suppose the price of a television falls by 15%. If consumers respond by purchasing significantly more televisions, the product has high price elasticity. On the other hand, if the price of table salt increases but consumers continue buying almost the same quantity, salt has low price elasticity. Businesses use price elasticity of demand while deciding whether to increase prices, whether to offer discounts, whether promotional pricing will increase sales, how consumers are likely to react to price changes. For most firms, this is the most important type of elasticity because pricing directly affects revenue and profit. 2. Income elasticity of demand, YED. The second type is income elasticity of demand. Instead of studying price changes, this elasticity measures how demand changes when consumer income changes. Suppose a person's monthly income increases from 40,000 Indian rupees to 60,000 Indian rupees. Will they continue buying the same products? Not necessarily. Higher income usually encourages consumers to purchase better quality clothing, premium smartphones, air conditioners, branded products, holiday packages. Therefore, the demand for normal goods generally increases when income rises. However, the opposite happens for inferior goods. For example, when people's income increases, they may stop purchasing low-quality products and switch to superior alternatives. Thus, income elasticity helps businesses forecast future demand by analyzing changes in income levels. Automobile companies, luxury brands, housing developers, and tourism businesses closely monitor income elasticity before making investment decisions. 3. Cross-elasticity of demand, XED. The third type is cross-elasticity of demand. This measures how the demand for one product changes when the price of another product changes. The table refers to this as sensitivity to price changes of related goods. These related goods may be substitutes or complements. Let us understand both. Substitute goods. Suppose the price of coffee increases. Many consumers may start buying tea instead. As a result, the demand for tea increases. This indicates a positive cross-elasticity because the demand for one product moves in the same direction as the price of its substitute. Other examples include butter and margarine, Pepsi and Coca-Cola, Android phones and iPhones. Complementary goods. Now consider complementary goods. Suppose the price of petrol increases sharply. Operating a car becomes more expensive. Consequently, some consumers postpone purchasing new cars. Therefore, the demand for cars decreases. Here, the demand for one product moves in the opposite direction of the price of its complementary product. Other examples include cars and petrol, printers and ink cartridges, smartphones and mobile accessories. Understanding the table. Now let us carefully interpret the table shown on the slide. The table summarizes all three elasticities in a simple manner. Price elasticity studies changes in demand due to changes in the product's own price. Income elasticity studies changes in demand resulting from changes in consumer income. Cross-elasticity studies changes in demand caused by changes in the prices of related goods. Although these three concepts measure responsiveness, each focuses on a different determinant of demand. Business importance. These three elasticities play a crucial role in business decision-making. For example, a smartphone company studies price elasticity before deciding whether to reduce prices during a festive sale. A luxury car manufacturer studies income elasticity because higher-income consumers are more likely to purchase premium vehicles. A tea manufacturer studies cross-elasticity by observing changes in coffee prices to estimate future demand for tea. Similarly, governments also use these concepts while designing taxation policies, subsidy programs, and trade policies. Therefore, understanding these different types of elasticity enables businesses to predict consumer behavior more accurately and make informed pricing, production, and marketing decisions. In the next slide, we will study the total outlay method of measuring price elasticity of demand. We will carefully analyze the table shown on the slide and understand how changes in price and total expenditure help economists determine whether demand is elastic, unitary elastic, or inelastic. So far, we have understood the meaning of elasticity and the different types of demand elasticity. The next important question is, how do economists actually measure whether demand is elastic or inelastic? There are several methods of measuring elasticity, and one of the simplest and most practical methods is the total outlay method, also known as the total expenditure method. This method was developed by the economist Alfred Marshall. If you look at the slide, you will notice a table containing three columns. Price change, total expenditure, price times quantity. Elasticity type. This table helps us determine the nature of demand simply by observing what happens to total expenditure when the price of a commodity changes. Before interpreting the table, let us first understand what total expenditure means. Total expenditure, sometimes called total outlay, is the total amount spent by consumers on purchasing a commodity. It is calculated using a very simple formula. Total expenditure equals price times quantity demanded. For example, suppose the price of a notebook is 100 Indian rupees and a student purchases 10 notebooks. The total expenditure will be 100 Indian rupees times 10 equals 1,000 Indian rupees. Now imagine the price changes. If the total amount spent by consumers also changes, we can determine whether demand is elastic or inelastic. Let us now interpret each row of the table. Case 1. Elastic demand, E greater than 1. The first row states, when the price falls, total expenditure increases. This indicates elastic demand. Let us understand why. Suppose a shirt originally costs 1,000 Indian rupees and consumers buy 100 shirts. The total expenditure is 1,000 Indian rupees times 100 equals Indian rupee 1,000,000. Now the company reduces the price to 800 Indian rupees. Because the price has fallen, many more consumers decide to purchase the shirt. Suppose sales increase to 140 shirts. The new total expenditure becomes 800 Indian rupees times 140 equals Indian rupee 1,12,000. Notice what happened. Although the price decreased, total expenditure actually increased because the increase in sales was proportionately much larger. This tells us that consumers were highly responsive to the price reduction. Therefore, demand is elastic, and the elasticity coefficient is greater than 1, written as E greater than 1. Case 2. Unitary elastic demand, E equals 1. The second row says, when the price falls, total expenditure remains the same. This indicates unitary elastic demand. Here, the percentage increase in quantity demanded is exactly equal to the percentage decrease in price. For example, initially, price equals 100 Indian rupees. Quantity equals 100 units. Total expenditure equals 10,000 Indian rupees. Now suppose the price decreases to 80 Indian rupees and demand increases to 125 units. The new expenditure becomes 80 Indian rupees times 125 equals 10,000 Indian rupees. The total amount spent remains unchanged. This means the increase in quantity exactly offsets the decrease in price. Hence, the elasticity coefficient is equal to 1. Case 3. Inelastic demand, E less than 1. The third row states, when the price falls, total expenditure decreases. This represents inelastic demand. Here, consumers do not respond strongly to the price reduction. Suppose petrol costs 100 Indian rupees per liter and consumers purchase 100 liters. Total expenditure is 10,000 Indian rupees. Now the price falls to 90 Indian rupees, but consumers purchase only 105 liters because they do not need much additional petrol. The new total expenditure becomes 90 Indian rupees times 105 equals 9,450 Indian rupees. Notice that total expenditure has actually decreased. This tells us that the increase in quantity demanded was too small to compensate for the lower price. Therefore, demand is inelastic, and the elasticity coefficient is less than 1. Understanding the table. The table on the slide summarizes this entire concept very effectively. Whenever you observe, price falls and total expenditure increases, demand is elastic. Price falls and total expenditure remains unchanged. Demand is unitary elastic. Price falls and total expenditure decreases. Demand is inelastic. Students often memorize these results, but it is much more important to understand why they occur. The total outlay method is particularly useful because it does not require any complicated mathematical calculations. Instead, we simply observe the relationship between price and total expenditure. Business importance. This method is widely used by businesses when making pricing decisions. For example, suppose a supermarket is considering offering a 20% discount on a product. Before implementing the discount, managers estimate whether total sales revenue is likely to increase. If demand is elastic, lowering the price can increase total revenue. If demand is inelastic, reducing the price may actually reduce revenue. Similarly, governments use this concept while deciding taxes on products such as fuel, tobacco, and alcohol. Since these products generally have inelastic demand, increasing taxes usually increases government revenue without causing a significant reduction in consumption. Thus, the total outlay method provides a simple yet powerful tool for understanding consumer behavior and making effective pricing decisions. In the next slide, we will study the percentage method of measuring elasticity. We will explain the formula shown on the slide, understand how elasticity is calculated mathematically, and learn how to interpret values that are greater than 1, equal to 1, or less than 1. In the previous slide, we learned about the total outlay method, which helps us classify demand as elastic, unitary, or inelastic by observing changes in total expenditure. While that method is simple and useful, economists often require a more precise numerical measure of elasticity. This is where the percentage method becomes important. If you look at the slide, you will notice the mathematical formula used to calculate price elasticity of demand, PED. The formula is price elasticity of demand equals percent change in price, percent change in quantity demanded. This formula compares two percentage changes: the percentage change in the quantity demanded and the percentage change in the price of the commodity. The result tells us how sensitive consumers are to price changes. Let us understand this formula step by step. Suppose the price of a product increases by 10%, and because of this increase, the quantity demanded falls by 20%. Using the formula, PED equals 20% divided by 10% equals 2. The elasticity is 2, which means demand is elastic because consumers reacted strongly to the price change. Now consider another example. Suppose the price again increases by 10%, but the quantity demanded decreases by only 5%. Applying the formula, PED equals 5% divided by 10% equals 0.5. Since the value is less than 1, demand is inelastic. Consumers did not reduce their purchases significantly despite the increase in price. Now let us understand the interpretation given on the slide. The slide clearly mentions that elasticity greater than 1, E greater than 1. When the elasticity value is greater than 1, demand is said to be elastic. This means consumers are highly responsive to changes in price. Luxury goods, branded products, expensive electronics, restaurant meals, and holiday packages often have elastic demand because consumers can postpone their purchases or switch to alternatives. For example, if the price of a premium smartphone increases significantly, many consumers may delay buying it or choose another brand. Elasticity equal to 1, E equals 1. When elasticity is exactly equal to 1, demand is called unitary elastic. In this situation, the percentage change in quantity demanded is exactly equal to the percentage change in price. As we studied in the previous slide, total expenditure remains unchanged because the increase in quantity exactly offsets the decrease in price. This situation is less common in real markets, but is important for economic analysis. Elasticity less than 1, E less than 1. When the elasticity value is less than 1, demand is inelastic. Consumers are not very responsive to price changes. Examples include salt, electricity, petrol, essential medicines, cooking gas. Even if prices increase, consumers continue purchasing these products because they are necessities. For example, a diabetic patient cannot stop buying insulin simply because its price has increased. Therefore, the demand for essential medicines is generally inelastic. Understanding the formula visually. The formula shown on the slide may appear mathematical, but its interpretation is actually very simple. Think of elasticity as a measure of consumer sensitivity. A large numerical value means consumers react strongly. A small numerical value means consumers react only slightly. Therefore, elasticity measures the degree of responsiveness, not merely the direction of change. Business applications. This formula is extremely valuable for business managers. Suppose an airline is considering increasing ticket prices. Before making the decision, the company estimates the price elasticity of demand. If demand is elastic, increasing prices may reduce bookings sharply, resulting in lower revenue. However, if demand is inelastic, the airline can increase prices with only a small reduction in passengers, leading to higher revenue. Similarly, supermarkets, mobile phone companies, automobile manufacturers, and online retailers regularly estimate price elasticity before announcing discounts or revising prices. Governments also use this formula while designing taxation policies. Taxes are often imposed on products with inelastic demand, such as fuel, tobacco, and alcohol, because consumption does not decline substantially even after prices increase. This allows governments to generate higher tax revenue. Thus, the percentage method provides a scientific and accurate measure of consumer responsiveness and forms the basis of many business and policy decisions. In the next slide, we will study the strategic business applications of elasticity of demand. We will understand how businesses and governments use elasticity while making decisions related to pricing, taxation, wage determination, and international trade, and we will explain each application mentioned on the slide with practical examples. So far, we have understood the concept of elasticity of demand, its different types, and the methods used to measure it. The next important question is, why is elasticity so important in the real business world? The answer is that elasticity is one of the most practical tools used by business managers, governments, economists, and policymakers. It helps them make informed decisions regarding pricing, taxation, wages, production planning, and international trade. If you look at this slide, you will notice 4 major applications of elasticity: pricing policy, government tax policy, factor pricing, international trade. Let us discuss each of these in detail. 1. Pricing policy. The first, and perhaps the most important application, is pricing policy. Every business wants to determine the right price for its products. Setting a price that is too high may reduce sales, while setting it too low may reduce profits. This is where elasticity becomes extremely useful. Suppose a company manufactures premium smartphones. Before increasing the price, the company first studies the price elasticity of demand. If demand is elastic, consumers are highly sensitive to price changes. Even a small increase in price may cause many customers to switch to competing brands. In this case, increasing the price could actually reduce total revenue. On the other hand, if demand is inelastic, consumers continue buying the product despite a price increase. In such a situation, the company can safely increase prices and earn higher revenue. Similarly, during festive seasons, businesses often reduce prices through discounts and promotional offers. They do this because they expect a significant increase in sales volume, especially for products with elastic demand. Thus, elasticity helps firms decide whether to increase prices, reduce prices, or maintain existing prices. 2. Government tax policy. The second application mentioned on the slide is government tax policy. Governments also study elasticity before imposing taxes. The slide specifically mentions fuel and salt, which generally have inelastic demand. Let us understand why. If the government increases the tax on petrol, most people continue purchasing petrol because they need it for transportation. Although they may reduce unnecessary travel slightly, they cannot completely stop using fuel. Therefore, consumption does not decrease significantly, and the government collects higher tax revenue. The same principle applies to products such as diesel, LPG, electricity, cigarettes, alcohol. Since demand for these products is relatively inelastic, governments often impose higher taxes on them. However, governments are usually cautious about taxing products with highly elastic demand because higher prices could cause consumers to stop purchasing them, reducing tax collections. Thus, elasticity plays an important role in designing an effective taxation policy. 3. Factor pricing. The third application is factor pricing. The slide mentions that the wages of labor depend on the elasticity of demand for the final product. Let us understand this concept. Suppose workers are employed in the production of luxury furniture. If the demand for luxury furniture declines sharply because of higher prices, the company may reduce production. As production decreases, fewer workers are required, which may affect employment opportunities and wage levels. On the other hand, consider workers employed in pharmaceutical companies producing life-saving medicines. Since the demand for essential medicines is relatively inelastic, production remains stable and employment opportunities are generally more secure. Thus, the demand for labor depends indirectly on the demand for the goods and services that workers help produce. For this reason, elasticity also influences decisions related to wages, recruitment, and workforce planning. 4. International trade. The fourth application is international trade. Countries regularly export and import goods and services. The success of international trade often depends on the elasticity of demand for exported and imported products. Suppose India exports tea to several countries. If foreign consumers are highly responsive to price changes, even a small increase in the price of Indian tea may reduce exports because buyers switch to tea supplied by other countries. However, if Indian tea has unique quality and demand is relatively inelastic, exports may remain stable despite moderate price increases. Similarly, countries study the elasticity of imported goods before changing tariffs or customs duties. Elasticity, therefore, plays a major role in determining trade policies, export strategies, and international competitiveness. Connecting the four applications, let us briefly summarize the practical importance of elasticity. Businesses use elasticity to develop effective pricing strategies, estimate future sales, plan production levels, maximize profits. Governments use elasticity to design taxation policies, estimate tax revenue, develop subsidy programs, frame trade policies. Economists use elasticity to predict consumer behavior, analyze market conditions, evaluate public policies. Thus, elasticity is not merely a theoretical concept. It is an essential decision-making tool used in almost every area of economics and business management. Conclusion. The four applications shown on this slide demonstrate that understanding consumer responsiveness helps organizations make better financial, production, and marketing decisions. Whether a company is deciding the price of a product, a government is imposing taxes, or a country is planning its export strategy, elasticity provides valuable guidance for achieving efficient and informed economic decisions. In the next slide, we will conclude this unit with a summary of the key concepts, where we will review everything we have learned, from the law of demand to the various types and applications of elasticity of demand, and connect these ideas into one comprehensive understanding of consumer behavior. We have now reached the end of this unit. Before we conclude, let us take a few minutes to review the key concepts we have discussed throughout this lecture. If you look at the slide, it states that the law of demand establishes the foundation, while elasticity provides the precision required for real-world economic decision-making. This single statement beautifully summarizes the relationship between these two important concepts. Let us understand this in detail. We began by studying the law of demand, one of the fundamental principles of microeconomics. The law tells us that, other things remaining constant, there is an inverse relationship between the price of a commodity and the quantity demanded. In simple terms, when the price of a product increases, consumers generally purchase less of it, and when the price decreases, they purchase more. We also learned that this relationship is represented by the downward-sloping demand curve, which visually demonstrates the negative relationship between price and quantity demanded. We understood that this law operates under the assumption of ceteris paribus, meaning factors such as income, consumer tastes, and the prices of related goods remain unchanged. Next, we discussed the determinants of demand. We learned that demand is influenced not only by price, but also by several other factors such as consumer income, prices of substitute and complementary goods, and changes in tastes and preferences. These factors do not cause movement along the demand curve. Instead, they shift the entire demand curve either to the right or to the left. We then examined two important exceptions to the law of demand. The first exception was Veblen goods, where demand increases with price because consumers associate higher prices with prestige, luxury, and social status. The second exception was Giffen goods, where low-income consumers may purchase more of an inferior staple even when its price increases because they cannot afford better alternatives. These exceptions showed us that although the law of demand is generally valid, consumer behavior can sometimes differ under special circumstances. After understanding the law of demand, we move to the concept of elasticity of demand. While the law of demand tells us the direction of change, elasticity tells us the degree of change. In other words, elasticity measures how responsive consumers are to changes in price, income, or the prices of related goods. We studied the three major types of elasticity. Price elasticity of demand, which measures the responsiveness of demand to changes in the commodity's own price. Income elasticity of demand, which explains how demand changes when consumer income changes. Cross elasticity of demand, which measures how the demand for one product changes because of changes in the price of another related product. We also learned two important methods of measuring elasticity. The first was the total outlay method, where we observed changes in total expenditure to determine whether demand was elastic, unitary, or inelastic. The second was the percentage method, where elasticity is calculated mathematically using the percentage change in quantity demanded divided by the percentage change in price. Finally, we discussed the practical applications of elasticity. We saw that businesses use elasticity to develop pricing strategies, estimate future demand, and maximize profits. Governments rely on elasticity while designing tax policies, determining subsidies, and formulating international trade policies. Thus, elasticity is not just a theoretical concept, but an essential tool for economic planning and business decision-making. The slide rightly concludes that the law of demand provides the foundation, while elasticity adds precision. Together, these concepts enable economists, managers, and policymakers to understand consumer behavior more accurately and make informed decisions. With this, we conclude Unit 4, Law of Demand and Elasticity of Demand. Thank you for your active participation throughout this lecture. I hope this unit has helped you understand not only how consumers respond to price changes, but also how businesses and governments use these concepts in real-world decision-making. In the next unit, we will continue our study of microeconomics by exploring another important concept that builds upon the ideas discussed in this lecture. Thank you. and I look forward to meeting you in the next session. We have now reached the final slide of this unit. This slide is designed to help you revise the important concepts that we have studied and encourage you to explore the subject further through recommended readings. Learning economics does not end with understanding definitions and theories. The real objective is to develop the ability to apply these concepts to practical situations. The exercises given on this slide are intended to test your conceptual understanding and analytical skills. Let us briefly discuss each of the questions. The first question asks you to explain why the demand curve slopes downward. While answering this question, remember the reasons we discussed during the lecture. You should explain that the demand curve slopes downward because of the inverse relationship between price and quantity demanded. You may also mention the income effect, substitution effect, and the law of diminishing marginal utility, all of which explain why consumers buy more when prices fall and less when prices rise. The second question asks you to calculate the price elasticity of demand when price rises by 10% and demand falls by 5%. Using the percentage method, we calculate elasticity as price elasticity of demand equals percentage change in quantity demanded divided by percentage change in price. So, PED equals 5% divided by 10% equals 0.5. Since the elasticity value is less than 1, the demand is inelastic. This means consumers are not highly responsive to the price increase. The third question asks you to discuss the exception of Veblen goods in luxury markets. While answering, explain that Veblen goods are luxury products whose demand may increase when their prices increase because consumers associate high prices with prestige, exclusivity, and social status. Examples include luxury watches, premium cars, designer handbags, and high-end jewelry. These goods do not follow the normal law of demand because purchasing decisions are influenced by status rather than price alone. The slide also recommends two excellent textbooks for further study. The first is Principles of Economics by N. Gregory Mankiw. This book provides a simple and practical explanation of demand, elasticity, and consumer behavior with numerous real-world examples. The second recommended book is Microeconomics by Paul Samuelson. It is a classic text that explains economic theories in greater depth and helps students build a strong conceptual foundation. I encourage all of you to read these books because they provide additional illustrations, case studies, and numerical examples that will strengthen your understanding of microeconomic principles. As you prepare for examinations, do not simply memorize definitions or formulas. Focus on understanding the logic behind each concept and practice solving numerical problems related to elasticity. The more examples you work through, the more confident you will become in applying these concepts to real-life situations. With this, we conclude Unit 4, Law of Demand and Elasticity of Demand. Thank you for your attention and active participation throughout this lecture. I hope this unit has given you a clear understanding of how consumer demand behaves, how elasticity is measured, and why these concepts are so important for businesses, governments, and economists. I wish you all the very best in your studies, and I look forward to meeting you in the next unit. Thank you.